Roger Montgomery from Montgomery Investment Management, and welcome to this week's video insight. The increasing frequency of research papers coming from brokers and commentators across our desks that are predicting a crash or a correction in the stock market have us wondering. We know that fund managers, many of them, currently have maximum cash balances, whether that be 5% for an individual fund or 50% for another. But maximum cash in the balance sheets or portfolios of fund managers leads us to conclude that any correction in share prices might be short-lived. That cash is obviously freely available to be used to purchase stocks on any dip, which would limit the extent of its market decline. So the question about whether or not share prices are overextended and due for a fall is one that requires some thought. Have a look at this chart. This first chart shows the premium or discount between market prices and our estimate of intrinsic value for the top 100 companies excluding resources. Now what you can see here, and this is proprietary, this calculation in this chart to Montgomery, but what you can see here is that we're currently seeing the highest premium between price and intrinsic value. In other words, prices are higher than intrinsic value since the series begins in January 2006. So that suggests to us that we're no longer at fair value, we're something above fair value, but we're not so significantly above previous instances of this occurring. So that brings me to another question. How can we decide whether or not there's enough of a premium here to be worried about, or whether we should feel rather sanguine and continue to invest as we always have? Well, unfortunately, we don't have that flexibility, and simply that is a function of the fact that we have to buy individual companies when they represent good value, and they have to be high quality. If there's an absence of that in the market, we simply increase our levels of cash. And so both our domestic funds, the Montgomery Private Fund and the Montgomery Fund, are holding close to maximum cash levels. So maybe there's some guidance available by looking across the ocean at the United States. This chart here is one you've probably seen before. It's the Cape-Shiller PE ratio, and it's calculated slightly differently because the E in the PE ratio is a 10-year average of earnings. And of course this is based on the S&P 500. Now here the picture is a little bit more extreme because this chart you can see goes all the way back to the late 1800s. And you can see that there were really only two instances just prior to the Great Depression and just prior to the tech wreck where the PE ratio, or the Cape-Shiller PE, was higher. And so that suggests that there is some enthusiasm built into stock prices in the United States. So let's look back at this chart again of the Cape-Shiller PE on the S&P 500 and make an observation that Jeremy Grantham made. He noted that the average of the PE ratio, which appears to mean revert, the average prior to 1994 was much lower than the average after 1994. And what gives that thought some credibility is the idea that the market has spent most of its time above the average prior to 1994, after 1994. In fact, even during the depths of the GFC, the PE ratio failed to significantly fall below the average of the period prior. So has something else shifted? Have we reached a permanently high plateau below which PE ratios will never descend? Well, I'm not sure about that, and I'm always reluctant to conclude that we're seeing a new phenomenon in the market that's permanent. So maybe we need to dig a little bit deeper. This next chart that you can see plots the S&P 500, and let's focus on that period after 1994, against corporate profit margins. And this is corporate profit margins measured as a percentage of the inflation-adjusted or real GDP. Now, there is a debate about whether or not the mean reverting nature of this particular series in fact is something that's going to continue, and you need to be able to explain why it would mean revert. But nevertheless, what you can see is that the decline in the corporate profit margins as a percentage of GDP tends to precede a decline in the stock market. And right now you can see that corporate profits as a percentage of GDP, real GDP, have actually been declining. But the timing, of course, is again rather rough. We can't simply say the stock market is due for an imminent correction. And that brings us to our fourth chart. On this chart, and I'll take some time to explain it, you can again see the S&P 500 changes since 1995 plotted against a histogram. Now the histogram, the red and the green, is inverted, but what it's actually showing you is the level of cash balances, or the net cash or net debt balances in margin loans on the New York Stock Exchange. And you can see that whenever there's been a sharp decline in the level of debt, so when balances have moved from high debt levels to a credit balance, that's pulled money out of the stock market, and the stock market has subsequently declined. And the leading indicator nature of this particular chart seems to be between 1 and 6 months. If you move to the period today, you can see that we've still got record debt margins or debt balances in New York Stock Exchange margin loans, suggesting that the stock market isn't at imminent risk of a correction. Of course, if those debt balances reduce and move into credit balances, then you might find the stock market is on borrowed time. So let's conclude. We know that the market isn't cheap, but we also don't have a reliable indicator for determining when it will stop being expensive. The best that we've got from this series of charts appears to be credit balances or debt balances in margin loans on the New York Stock Exchange. That's probably the indicator to watch before we have this discussion again. I look forward to seeing you next week, and in the meantime, please continue to follow us on Facebook and Twitter.